Hey, good morning, everyone. Marty Missouri here. It's the 18th of September, 2025, Thursday. Folks, today will be the end of week update, looking at my calendar today, tomorrow, and over the weekend. I could circle back late in the weekend after I perform the weekly macro analyses if I think there's anything that I need to share with you. Otherwise, be back probably to the normal schedule next week, Tuesday or Wednesday. I'll offer up a commentary, and then, of course, the end of week next week. Lots to talk about, but doesn't have to all be talked about in one sitting. Clearly, the news of the week is the Fed and yesterday's decision, which was quite interesting indeed. I was reading from Bespoke's research just a little bit ago, and I thought, they pretty much summed up my thinking really well, so I'll just leverage their note here. So we got the 25 basis point cut, which was completely priced in. 50 basis points, like some people were, asking for, just wasn't priced in. And like I said, if it were me, I'd do the 25 basis points because of weakness in the labor market. And we're seeing underlying weakness in other spots as well. Our, call it economic index, still is slightly in the red. But that I would wait thereafter, just kind of see how the data continue to come in. And so that, more or less made sense, although they are pricing in and anticipating more cuts this year, and I believe even next. What really was interesting to me and quite odd was that while they cut interest rates, they actually upped their inflation forecast for 2026 and their GDP growth forecast for this year, and the next two were also raised. So typically, you're not cutting interest rates into a higher inflation forecast or a faster growth forecast. And the icing on the cake was that the unemployment forecast for this year was unchanged, not expected to rise anymore. And it was actually revised lower for the next 2 years. So even Bespoke says here, this was a very strange cut given raised forecasts for growth and inflation, but a lower unemployment view. Very strange indeed. So Powell did his best to justify that. And he said, basically, this is a risk management cut. Clearly, we don't have solid labor markets. At least that's what the unemployment rate is suggesting currently. And we think job openings coming down and that sort of thing. So the downside risks to the labor market, he'd been noting, are now a reality. And that has skewed how the FOMC thinks about the balance of risks. So you could argue that they're saying, inflation risk be damned. We are going to just focus on the underlying economy. Now, I've said it over and over again, and our long-term thesis is that we are now in a secular rising inflation or stubbornly high inflation environment, which comes with this move very solidly into a global populist regime. And as you can see, the FOMC is acting accordingly. Also, remember all the presentations the last 2-3 years that I've done for you on yield curve control during and post World War II, where the Fed actually capped the yield curve, let inflation run hotter so that the government could refinance the war debt and finance its very high budget deficit at that time with less onerous interest rates, with lower interest rates. And essentially, with inflation, the U.S. economy grew its way out of close to 120% debt to GDP to something notably lower than that over the course of about 9 years. And I've said that that is probably the prescription that they're ultimately going to have to segue to in this environment as well. Now, whether it's done in a very friendly, coordinated manner like it was in the World War II era, or is it something that just is going to happen without, the formal documenting that this is what we're doing? We'll see. But this feels like, yield curve control, where we're going to kind of flatten out or cap the yield curve, at least on the short end. so that the Treasury can continue to borrow at very short-term rates, which is what they pretty much announced that they're going to do going forward from here. Anyway, to kind of cap this topic, very unusual and uncharacteristic of the Fed, at least relative to their dual mandate, that they would be talking up inflation and cutting interest rates at the same time. And so we'll see how it plays out. And yes, this morning, yields are rising. So mortgage rates are actually going up a bit this morning, a day after the Fed has cut interest rates. Now, also what came out this morning was jobless claims coming right back down. Remember last week I talked about the spike in jobless claims inspiring a rally in the market, in kind of a bad news is good news. Bad news because it's going to embolden the Fed to aggressively cut interest rates, or it's going to certainly seal the deal. What I didn't understand at the time, and I found out shortly after shooting that video because I just hadn't looked at the details, is that the majority of that spike came from some anomaly in the Texas data. So it makes sense that it would turn right around and come back down today. And on that come back down today, yields spiked, bonds fell, and so on. Bond prices fell, and I'll show you a chart here in a minute. But the market is up pretty nicely. At least the S&P is up, and tech stocks are up today. One of our positions, it's a small position, Applied Materials, which is a chip equipment maker, is up 6.5% today. That's because there was an announcement early this morning that NVIDIA is going to invest $5 billion into Intel, which is the company that you should know the government took a 10% equity stake in recently. So chip stocks are having quite the day. Otherwise, the market kind of all over the place. The volatility index, the VIX, was actually threatening a positive move, which reflects ongoings in the options space. Tomorrow is a huge expiration of options. That could come with some volatility, but we'll see. Those higher yields this morning are sparking quite the pop in the dollar, although it's off of its high a little bit as well. As for our core portfolio this morning, being very dollar sensitive, which explains our notable outperformance so far this year, it's actually down 10 basis points. We've had a really good run, though, the last couple of weeks, leading into, the Fed announcement as the dollar was dropping, anticipating lower interest rates. I do think that there is some upside potential, if not only just technically speaking, for the dollar. So this week we're stress testing the portfolio. We do know we are sensitive to moves in the dollar on balance. And so we're just making sure we're not taking too much risk there, and we will adjust accordingly if we really begin to develop a strong thesis that the dollar's got a higher path to go here for a somewhat extended period of time. Longer term, vis-a-vis what I just told you about the yield curve and so forth, a lower dollar theme makes a tremendous amount of sense for a well-managed, diversified portfolio. But again, we need to assess the short, intermediate, and long-term prospects as we're managing other people's money as well. Okay, so I think that probably is all we need to talk about overall conditions. And of course, I'll be back next week to talk about other topics that are on my mind as well. Let's just, since I have it up here, let's take a quick look at valuations. Robert Shiller's CAPE, cyclically adjusted price to earnings ratio, is one of the most highly respected valuation tools out there. Save for the tech bubble phenomenon right here, we are in seriously expensive territory. Warren Buffett, the ultimate value investor, it's understood that his favorite metric is the total market cap, total size of the U.S. market, relative to GDP at something like 217% currently. It is at an all-time high valuation. Our three metrics that we chart right here, price to earnings ratio, is up there very much in that high territory. I think price to sales is a better look at valuations. It is at all-time high territory, as is price to book value, or I should say, I guess right here it did get a little higher. So we're right there at all-time high territory in price to book value as well. So, folks, as you can see here we have very high valuations. We have stocks holding their own. Valuations are the worst timing tools, right? People get all bound up about them. For us, they're more about a look into the future. How well can the market really do on a sustained basis coming off of these valuations? In the last 2 or 3 videos, I showed you an analysis that says that they really don't make money on a 10-year basis. The U.S. market doesn't, coming off of these valuation levels. And it's about 50-50, maybe a little skewed to the upside over the next year from such valuation levels. So time will tell, but clearly stocks ain't cheap in the U.S. as I speak. As for the technicals, here's the S&P at all-time highs, coming off of that a little bit today with today's candle. So it's the top of the wick there shows where it's been. The body shows where it is. And we have a buy signal here on the MACD, but we have a very long negative divergence. And I've shown you over and over and over again over many years how this is not a sell signal, but it says that the market's heavy as momentum is kind of dying here. And you can see that on the 2 momentum indicators. Same thing on the NASDAQ. I'll redraw my lines here, but that's a rising wedge pattern with negative divergences and in overbought territory. Were it not for today's Intel news, I do think the market would be reacting, I think, notably negatively to the rise in yields today, coming off of a drop in interest rates or a drop in the Fed funds rate yesterday. So here's the dollar having a nice rally today. Here are yields having quite the pop. Still up here, you can see it's quite the candle, but we're still up here toward the high end on yields, which means mortgage rates are going up a little bit today. Gold coming off the boil a little bit. Remember, I've been targeting this one for some weakness inevitably, and I've shown you the charts. I showed you the spot gold price. And when it's been where it is now, when you look at its overboughtness, it's always given us a double-digit correction. So we'll see. 3 days down, we'll see how that plays out. I mentioned the VIX. We do have this divergence here where the VIX is showing us a higher low against all-time highs. And I showed you here over the last 5 years or so, that pretty good indicator that we're going to see some corrective action in stocks. Maybe this time will be different. Remains to be seen. I showed you the valuation metrics. So folks, I'm going to do a hard stop right there. More to come, of course, mid next week or early next week. And we'll just keep you posted on what we're thinking and why. Hope you have a great weekend. Talk to you soon. Bye-bye.